Imagine you are the CEO of American Express in November 1963. Your company is one of the most respected, untouchable financial institutions on the planet. You deal in luxury, travelers' checks, and elite credit cards. But overnight, your stock plummets by more than 50%, wiping out millions in market value and threatening to bankrupt your century-old empire. You haven't made a bad tech bet, and there hasn't been a global economic collapse. Instead, your financial fortress has just been brought to its knees by salad oil. To be more specific, by non-existent salad oil. This is the story of the 1963 salad oil scandal, quite possibly the dumbest, most audacious scam in Wall Street history. It was a con that managed to swindle over $175 million, which is roughly $1.5 billion in today's money, from some of the world's biggest banks, prestigious brokerage houses, and international trading firms. And the mastermind behind this massive financial illusion wasn't a sophisticated Wall Street quant or a criminal genius with a PhD in economics. He was a high school dropout from the Bronx named Tino de Angelis, a man who grew up working in meat markets and quickly discovered that the easiest way to make money wasn't by following the rules, but by exploiting the blind arrogance of the financial elite. To understand how Tino pulled off a heist of this magnitude, we have to travel back to the post-World War II era. The United States government had just launched the Food for Peace program, an initiative designed to sell excess American agricultural products to impoverished countries in Europe and Asia through long-term, low-interest loans. It was part humanitarian effort and part geopolitical strategy to stop the spread of communism. But where the U.S. government saw charity and diplomacy, Tino de Angelis saw an absolute goldmine. Tino had already been busted once for selling uninspected, rotting meat to the federal government for school lunch programs, but that didn't stop him. In 1955, he formed the Allied Crude Vegetable Oil Refining Corporation and set up shop in a massive industrial wasteland of a tank farm in Bayonne, New Jersey. His plan was simple: dominate the export market for vegetable and salad oil under the government's new program. Within just a few years, Tino was shipping massive quantities of oil overseas. But the profit margins on legitimate vegetable oil were razor-thin, and Tino wasn't interested in slow, steady growth. He wanted a limitless supply of cash to speculate on commodities and build an untouchable corporate empire. To get that cash, Tino needed loans, and to get loans, he needed collateral. In the commodities business, that collateral sits inside giant, multi-story storage tanks. Banks won't just take your word that you have millions of dollars worth of oil sitting in New Jersey. They require rigorous verification from a trusted third party. Enter American Express. American Express wasn't just in the credit card and travel business. They had a specialized, highly profitable subsidiary called the American Express Field Warehousing Corporation. The setup was ingenious on paper. If a commodities trader like Tino had millions of gallons of liquid assets sitting in storage, American Express would officially lease his tank farm, put their own locks on the pipes, station their own inspectors on site, and issue official warehouse receipts certifying exactly how much oil was inside. These receipts were practically worth their weight in gold. Armed with these stamped certificates of guaranteed collateral, Tino could walk into any major bank or brokerage house in the world and borrow millions of dollars on the spot. And boy, did he borrow. Major players like Chase Manhattan, Bank of America, the international commodities trading giant Bunge, and the venerable Wall Street brokerage firm Era Haupt and Company were practically falling over themselves to hand Tino cash. He was paying generous interest rates, and after all, American Express itself was vouching for the collateral. What could possibly go wrong? Well, everything. Because Tino had discovered a fundamental law of physics that apparently eluded the greatest financial minds on Wall Street: oil floats on water. Tino's massive tank farm in Bayonne wasn't filled with valuable soybean or cottonseed oil. It was filled almost entirely with salt water pumped directly from the nearby Newark Bay, topped off with just a thin, few-inch layer of genuine salad oil to make it look convincing. To the naked eye, looking down from the top hatch of a 4-story steel tank, it looked like a literal ocean of liquid gold. But underneath, that shimmering surface was nothing but worthless seawater and industrial sludge. You might be wondering how on earth American Express inspectors fell for this week after week, month after month. The answer is a mind-boggling combination of outright bribery, clever physical illusions, and pure bureaucratic incompetence. For starters, Tino made sure the inspectors assigned to his Bayonne facility were thoroughly treated. He plied them with envelopes of cash, lavish meals, and gifts, effectively buying their loyalty or at least their willingness to look the other way. But even for the honest inspectors who actually tried to do their jobs, Tino's men had completely rigged the game. When an inspector climbed to the top of a tank to drop a measuring tape and a hollow tube down to check the depth and take a sample, they weren't dropping it into an open tank of oil. Tino's mechanics had secretly welded vertical metal pipes inside the tanks directly below the sampling hatches. These pipes were sealed at the bottom and filled to the brim with real, high-grade salad oil, while the rest of the massive tanks surrounding the pipe held millions of gallons of seawater. The inspectors were literally measuring the contents of a hidden metal cylinder over and over again. When inspectors got too curious or wanted to check a different tank that hadn't been rigged, Tino's crew would simply turn on a complex network of underground pumps to transfer the exact same small batch of real oil from one tank to another just before the inspector arrived. They were effectively counting the exact same puddle of oil 6 or 7 times over. And with every forged inspection report, American Express printed more warehouse receipts, and Wall Street blindly handed Tino de Angelis more millions. You might think that a man sitting on tens of millions of dollars in fraudulent loans would quietly pack his bags, wire his fortune to a Swiss bank account, and retire on a tropical island. But Tino de Angelis wasn't just a con artist. He was a compulsive gambler with an ego the size of a New Jersey tank farm. Instead of walking away, he took all of that borrowed cash and decided to pull off the ultimate Wall Street power play. He was going to corner the entire global market for soybean oil. Using his favored Wall Street brokerage firm, Ira Haupt & Company, Tino began buying up thousands upon thousands of soybean oil futures contracts on the Chicago Board of Trade. At one point, this single high school dropout from the Bronx controlled an astonishing 80% of the entire market for cottonseed and soybean oil futures. He was buying up contracts at such a furious pace that prices skyrocketed, creating a synthetic bubble that made his paper wealth explode even further. But this endless loop of borrowing money against fake oil to buy paper oil was creating a discrepancy so large it bordered on slapstick comedy. By the autumn of 1963, American Express Field Warehousing had issued receipts certifying that Tino had more than 1.8 billion pounds of vegetable and salad oil stored in his Bayonne tanks. Take a moment to let that number sink in. 1.8 billion pounds. If any of the brilliant financial analysts at Chase Manhattan, Bank of America, or American Express had simply bothered to check the publicly available reports from the United States Department of Agriculture, they would have made a horrifying discovery. According to the federal government, the total amount of vegetable oil stored in the entire United States at that time was only 1.5 billion pounds. Officially, on paper, Tino de Angelis somehow had 300 million pounds more oil sitting in a single New Jersey facility than actually existed in the entire country. Yet nobody blinked an eye. The banks were making too much money on interest, the brokers were raking in record-breaking commissions, and American Express was collecting massive warehousing fees. As long as the commodities market kept going up, the illusion held, and everyone was getting rich. But every speculative bubble in history eventually needs a pin to prick it, and for Tino de Angelis, that pin arrived in mid-November of 1963. Tino had gambled heavily on a geopolitical rumor that the Soviet Union was facing a catastrophic agricultural shortage and would be forced to buy massive quantities of American vegetable oil. He bet his entire leveraged empire on this incoming Soviet payday. But the deal never materialized. When news broke that the exporters weren't going to buy, the commodities market panicked, and the price of soybean oil suddenly began to free fall. The crash triggered an absolute avalanche of margin calls. Ira Haupt and Company, who had extended tens of millions of dollars in credit to finance Tino's trading spree, demanded immediate cash to cover the massive, bleeding losses on his futures contracts. For days, Tino tried to keep the wolves at bay by doing the only thing he knew how to do. He conjured up even more fake American Express warehouse receipts and handed them over as collateral. But the losses were mounting too fast, and the brokers didn't want paper anymore. They wanted hard, cold cash, and they wanted it now. On November 19, 1963, unable to meet a devastating $25 million margin call, Tino de Angelis officially filed for bankruptcy protection. That was the moment the music stopped, and Wall Street's elite scrambled to secure their collateral. Inspectors, creditors, and federal investigators rushed across the river to the freezing industrial tank yards of Bayonne, New Jersey, armed with court orders to seize the 1.8 billion pounds of oil that supposedly guaranteed their loans. But when crews actually opened the valves and began pumping out the massive steel tanks, the horrifying reality finally hit the daylight. There was no oil. Tank after tank, which had been valued at tens of millions of dollars, emptied out nothing but toxic, brackish seawater and foul industrial wastewater. Out of the $155 million in oil pledged to American Express, inspectors found just $6 million worth of actual vegetable oil. The rest was an absolute mirage. The fallout was instantaneous and catastrophic. Ira Haupt and Company, one of Wall Street's oldest and most respected brokerage houses, was left holding the bag for Tino's massive unpaid debts. Unable to meet its obligations, the firm collapsed overnight, marking one of the worst financial failures in the history of the New York Stock Exchange. The situation was so dire that the exchange itself had to step in with an emergency rescue fund to pay back the thousands of innocent retail investors whose life savings were trapped inside the ruined brokerage. Meanwhile, international trading giants like Bunge took massive multi-million-dollar write-downs, and several smaller financial firms simply vanished from the map. And then there was American Express. As the issuer of the fraudulent warehouse receipts, the century-old institution was legally and morally on the hook for over $60 million in damages. Panic gripped the market, and shares of American Express went into a terrifying tailspin, losing more than half their value in a matter of days. To make matters even more surreal, just 3 days after Tino's empire collapsed, President John F. Kennedy was assassinated in Dallas, sending the entire American financial system into an unprecedented state of shock and mourning. Yet, out of the ashes of Wall Street's dumbest scandal emerged one of the greatest investment plays of all time. A young, relatively unknown investor named Warren Buffett watched the American Express panic unfold from his home in Omaha. Buffett realized something that the terrified market had missed. While the warehousing subsidiary was a total disaster, American Express's core businesses, its credit cards and travelers' checks, were still generating massive, uninterrupted profits. People were still using their cards at restaurants and hotels every single day. Seeing the company on sale at a massive discount, Buffett aggressively scooped up 5% of American Express for roughly $13 million. Within a few years, as the company paid off its salad oil debts and the stock rebounded, Buffett's trade turned into a $200 million windfall, helping to launch the legend of the Oracle of Omaha. As for Tino de Angelis, the mastermind behind the illusion, he didn't fare quite as well. He was arrested, convicted of federal fraud and conspiracy, and sentenced to 20 years in prison, ultimately serving 7 before being released in 1972. His story remains a permanent, humiliating monument in the annals of financial history. The salad oil scandal proved that no matter how sophisticated, prestigious, or powerful Wall Street's institutions might seem, their greed can always be exploited. All it takes is a clever illusion, a little bit of bribery, and a willingness to believe that seawater can miraculously turn into gold.